Hi, so welcome to Model 25, Acquisition and Mergers. Now we've exhausted the major aspects of the syllabus, or some of the major aspects of the syllabus in relation to consolidation, and definitely the examiner is going to ask you a minimum of 25 mark question from that section of the syllabus, whether there is going to be, definitely there is going to be a complex group question, and then you're going to maybe asked to prepare some financial statements on foreign transactions and foreign subsidiary, very important, of the corporate reporting syllabus. So let's come to another key aspect of the syllabus, which is about acquisition and merger. Now note that acquisition and merger is both in corporate reporting and financial reporting, corporate reporting and financial, advanced financial management. So when you learn it in one subject, it is the same idea, the same application, the same principle in the other subject. So whether you're in advanced financial management or you're in corporate reporting, these things remain the same. Right. So let's begin with a definition. What is an acquisition and what is a merger? I believe you have an idea of this already because we've made references to some of these things in previous lessons. Acquisition is simply where a company buys another company or gains control of another company. That is an acquisition. So we buy the shares in another company, and that is an acquisition. But a merger is where two businesses combine to create a single company. That means that the previous companies will cease to exist. That is what a merger is about. Now, what are some of the advantages of acquisition? What are some of the advantages of acquisition? So, if for instance we have Premium Education Hub, then we have, let's say, Nifty College, then they are all in the education industry, then Nifty College acquires Premium Education Hub. What are some of the merits or the advantages of acquisition? One, off the bat, we can say that there is a reduction in what? Competition. So what is going to happen is that because the number of firms has now reduced, there is going to be a reduction in the competition. One. Then second one, it eliminates the barriers to entry. The reason is that once a business is it's acquired, that means that competition is less in the industry. So what it means is that new companies can come inside the business or inside the industry. Three, it enables the purchasing company to have greater market share and market power more quickly. So the company that is acquiring or purchasing the other company is going to gain what? Greater market share, because the market share is going to increase, the market power is going to increase, revenue is going to increase at a very quickly or very fast pace. And then the last one is that there is access to synergy. So synergy is where we say 1 + 1 is greater than 2. So that is what synergy is about. What it means is that now this is the same thing under merger also. So if two firms merges to form one firm, realize that the two of them now, they are greater than what? 2, as two separately. Their forces are going to come together, and that is going to be the issue about synergy. Now there are about 4 types of mergers that we can talk about: horizontal mergers, vertical mergers, concentric mergers. So let's look at them quickly. Horizontal mergers. This is where two businesses offering the same service or producing the same goods merge to form one company. So that is horizontal merger. So here, the companies are in the same industry, producing the same goods or rendering the same service, and they merge to form a single firm. That is what we call horizontal merger. Now, what this happened here is it's going to reduce competition in this case. 2. Vertical acquisition. So horizontal, we are all in the same industry doing the same thing. Vertical acquisition. This is where a producing company merges with either the supplier or distributor to form one company. So here, let's say we are producing dusters, and we have a supplier that supplies out with the wood, that supplies out with the carpets. So we have a major supplier like that. So we go to the supplier and say, listen, why don't we merge to form a single firm? That is what we call the vertical acquisition. Or a company distributes our duster. What we're going to say is that let's merge with that company so that we form what? A single firm. Now, this type of measure eliminates additional cost, because the supplier is going to sell the goods to us at a cost, at a margin or at a markup. We are also going to sell to the distributors at a markup. Then the distributors will sell to the final consumer at another markup. So if there is any merger in between these two groups, so whether we merge with our supplier or we merge with our distributor, one of them will reduce how much cost we are going to incur in producing the product, and that means that the price of the product is definitely going to be reduced for the consumer. The next thing is concentric diversification. So this is where we try to merge with a company that is in a different industry so that we can produce new products and take it to new markets, so we can take advantage of marketing synergy with existing products. Then we have conglomerate merger. This involves the merger of two unrelated businesses, right? Okay. Now, so in acquisition, we have what we call the acquiring company and then the target company. The target company is the firm that we are looking for to buy. So when we talk about a target company, there are criteria that helps to choose the target company that we want to acquire. So criteria to choose when deciding whether to acquire a target company may include answering the following questions. 1. Will the acquisition reduce competition? So if we want to acquire a company, the first question we want to ask ourselves is, when we acquire that company, will we reduce the competition in the industry, in the market? 2. Are there any synergies? So when we acquire them, is there any benefit that they have? That maybe there is a plant they have, there is a goodwill they have, there is a marketing strategy they have, there is a management team that they have that we can use as well as a company to gain competitive advantage? 3. Will it reduce the risks of the business? Very, very important. We will look at this in details when we're looking at valuation for initial IPO, that is initial public offer. Will there be any business risks or any risks that a business is going to be exposed to? Because usually when there is an acquisition of a business, the company may be exposed to either a business risk or a finance risk. So we will look at all these things later on. 4. Are there any technological benefits to be enjoyed? Example, research and development department in the target company. So that was what I was talking about in relation to synergy. So if there are any technological benefits that we can enjoy as a company, then we may go ahead to acquire that company. Next is that, are there opportunities for employees? Both our existing employees and the employees in the target market. And then the last one is, what are the cash resources of the target company? So you don't want to buy a business that is filing bankrupt, or you don't want to buy a business that is not having any cash at all. So you want to look at the cash reserves or the cash resources or the liquid assets of the company, so that when you buy them, you can as well get some money to reduce how much you incur. Now, when it comes to acquisition, when we acquire a business, there are various ways that we can finance the business. Now, I've thrown light on those when we were doing consolidated financial statements. When I told you that when it comes to acquisition, we can finance it by paying directly, cash exchange. We can finance it by undertaking what we call cash consideration, the first one. The second one is going to be like share exchange. So we're not going to pay anything. We're going to issue shares to the shareholders of the company that we are acquiring. Another one is, instead of issuing shares, what is going to be is that we're going to go for a loan and then we use it to acquire that business. So there are various ways through which acquisitions can be financed, and I've labeled out 4 of them here. So cash consideration. With a cash consideration, it can come from our retained earnings. It can come from bonds or taking bank loan. It can come from Mezzian finance, that is combining or raising finance both from debt and equity. Then it can also come from what we call vendor placing, that is offering shares to institutional investors so that they can buy. Next is share exchange, you know that already. Then debt finance, and then the last one is earn-out arrangements. Now I've included a table, and what the method of finance and how it will affect the buyer and how it will affect the target company. So for instance, if we buy the company and we pay outright cash, from the buyer's perspective, what will be the effect? And from the target perspective, what will be the effect? So when we buy outright cash, that is, we finance the acquisition by cash consideration. One, there will be issue of raising cash. So we have to find out where we're going to raise the cash. But in that case, there will be nothing like dilution of control, or what we call dilution of earnings per share. Because when we do exchange, share exchange, that will lead to dilution. So here, the buyer's perspective will be looking at, okay, how do we raise the money? And then if we are able to raise the money, it is good because there will not be any dilution in the control of the company. But from the target perspective, the amount is certain, so they are going to receive that amount and it ends there. And the capital gain tax to be paid by the shareholders. So the shareholders will think about the capital gain tax. Now, the capital gain tax here will be in relation to what are you going to get after their shares have been disposed of. So the taxman will be after them. So if the income tax and the capital gain tax is going to be high, then they are going to be reluctant in taking cash consideration, but they may go for share exchange instead. Then the next thing is when we issue share. When we issue share, from the buyer's perspective, they must consider the issue cost. That is how much they are going to incur in issuing these shares. Two, when we issue share, there is going to be dilution of the control and certainly dilution of the earnings per share, and then reduce gearing. Now when we issue share, it means the stated capital of the company will rise, so the gearing, that is the long-term solvency of the company, is going to fall. But from the target's perspective, the shareholders of the target perspective will be happy because there is an ongoing interest in the company. It means they still have investment in the company and they still are part owners of the company. Then the last one there is about debt finance. When we use debt finance to finance the acquisition, from the buyer's perspective, they are going to look at the obligation to pay interest. So if we are going to borrow money to buy the shares or to acquire that company, what is the interest to be paid on that loan? They have to consider that. Then also the fact that there will be increase in gearing, because when you take a loan to buy a business, there will be increase in the gearing of the company, because usually what happens is that the loan will be taken to buy the business, then the loan will be recorded in the target business. So it means the gearing ratio of the target business is really going to be high. From the buyers, from the seller's perspective, or from the target company perspective, they are going to have a fixed income there, and there will not be any limited, or there will not be any ongoing investment again in the business. So it is just like cash acquisition in that case. But debt finance is not only about going for a loan, it can also be issuing debt, long-term debenture notes to the shareholders. So if you issue long-term debenture notes to the shareholders, they don't have control of the business, but in a way, they are going to be having some income gradually, okay, every year in relation to that. Then I mentioned earn-out arrangement. With this method of finance, there is a structured payment plan where the acquiring company makes an initial payment and a deferred payment later. So that is what we call earn-out arrangement. So you remember what we did under consolidation, that at one time the company makes a payment at the date of acquisition, then it will promise and say, okay, maybe 2 years later we are going to pay the rest. So that is what we call earn-out arrangement. Now, there are advantages of this policy because it's one of the best. It's one of the best. There is a smaller initial payment to gain control. So that's it. If you're able to do that, you're able to negotiate this term of financing, then you need a small amount of money to gain control of the company, because if the company is being sold for $300 million, you can undertake an earn-out arrangement with them and say, listen, we're going to pay you $100 million now, and we will pay the $200 million after a year or after 2 years. So you are paying $100 million and you get control now. So it's a good news. 2, there is less risk since payment is spread over. So the risk involved here is less, because looking at the fact that raising $300 million at a go, and then paying 100 now and paying 200 2 years time or a year's time, that means that the risk involved is going to be less there. Then the last one is that there is a possibility of improved future performance in relation to that. Now let's look at the objectives of takeover or mergers. Takeover or mergers should increase the shareholders' value. So takeover or mergers should increase the shareholders' value via 1. Acquiring the target company at an undervalue. So one of the ways that the shareholders are going to benefit from a takeover is when we acquire the company under the value of the asset of the company. So for instance, the asset of the company is 300 million, but we are able to acquire it for 250 million. It means in this case, there is not going to be any goodwill, but we are going to be what? Making profit. And this profit will be reported in the income statement and will be taken to the retained earning, and that will be a benefit to the shareholders. Then the next thing is about synergistic benefits, right? Issues about the economic efficiency gain, that is gaining the a large scale of production, so you're going to enjoy economies of scale. Then financial strategy, you reduce your total risk. The market power, you also get more power or more authority in the market schedule. Now let's look at mergers and acquisition activity in different countries quickly. Due to the existence of well-developed capital markets, it is comparatively easy to launch a takeover in the UK and the US. So it is very easy to launch a takeover when it comes to US and UK. Why? Because the market is the capital market is well developed, and you can take over and launch an IPO and you are gone. To prevent monopolies forming, the US has strong antitrust legislation and the UK has a competition commission. So yes, there is merger on acquisition, but to prevent the issue of a monopoly, there is a measure, or there are policies there in the UK and in the US that controls when an acquisition can be taking place and when a merger can be taking place, so that there will be competition in the market and prices of goods and services may be less. To prevent, in continental Europe and Japan, banks, rather than shareholders, have traditionally taken a more direct role in financing and direct corporate activity. Other stakeholders such as employees and suppliers are also being more influential. So management in the UK, in Europe, and in America, and also Japan, what happens is that shareholders are on the board of directors. Financing companies like bank venture capitalists are on the board of the company. Then there are other non-executive directors, which include employees and even opinion leaders who influence decisions of the organization. Now let's look at the creditor issues on takeover. Now when we talk about the creditor issues, basically we're talking about the investment decision that we are making and how we're going to finance that investment decision. Now, the first question we're going to ask ourselves when we are talking about that is, how much is the target company worth to the creditor, right? 2, are the target stakeholders willing to sell? 3, what economic or industry and company assumptions underlie the valuation? So this is what we're going to do when we are trying to buy a company, right? So how much is the target company worth to us? We are the creditors and we are spotting the target. So how much is it worth to us? If we look at the financial statement, how much is it worth to us? 2, are the shareholders of that company really willing to sell the company? And then we will have to look at ourselves that what are the assumptions that we're going to use in the valuation. With a financing decision, we will go this way: the matching approval or the matching approach. 1, is the predator having an adequate surplus cash or borrowing capacity, ability to issue shares? So in a financing, we're going to ask ourselves, how are we going to finance this acquisition? Okay, do we have surplus cash to pay cash consideration, or do we have ability to borrow money directly to pay, or do we have the ability to issue shares? Because for instance, if we are not listed on the stock exchange market, then we can't undertake share exchange, right? But if we are listed, or if we will have to acquire that company, then we should make decisions to be listed, then we can be able to acquire the company. Then the second question on the financing in relation to the merchant is, can the group service the new finance required for the acquisition? So the money that required for the acquisition, can we pay for that? Now the cost is very important. So will the use of cash or share exchange make the predator's capital structure for better or worse? So whether we're going to use cash, whether we're going to use debt, whether we're going to undertake share exchange, will it make we the parent company or put us in a position that we have a good or worse capital structure? Is a question we need to ask ourselves. Then capital providers will also come. Will any existing debt covenants or existing shareholders' expectation be affected? So very important. If we are raising debt, then we have to look at the existing covenants that we have. Probably we have a covenant or an agreement with a bank that they have borrowed us money, and unless we pay the money, we can't raise another debt anywhere. So we will have to look at whether the new decision that we are undertaking will affect our that covenant, or in relation to existing shareholders, what is the expectation of the effect? For instance, if we undertake share exchange, then existing shareholders will not be happy because there will be dilution in control and there will be dilution in earnings per share. And you know, once there is dilution, how much you are earning is going to reduce in the company. 2. Could a predator issue convertibles to delay control dilution issue? So that is another issue that we can talk about. All right. So if we will do share exchange outrightly and it will affect our shareholders, is it possible that we can issue convertible loan notes so that we can delay the dilution? Maybe we can issue a convertible loan note for a 5 years convertible loan note so that the predators will be relaxed for 5 years before. So even though in the financial statement every year we'll be calculating diluted earnings per share, it will be delayed for 5 years before the actual dilution takes place. 3. Is the current dividend policy desirable or suitable after the acquisition? So the dividend policy of the organization, is it going to be desirable? Then the last one is, will the earnings per share be affected, or does it matter? So earnings per share will only be affected if we are doing share exchange, then earnings per share will be affected. Or if we are issuing convertible loan, earnings per share will be affected. But if you are doing cash consideration, all other things being equal, the earnings per share will even increase because the business will now have more market share. Then the next thing to talk about is the market issues. Often target companies are overvalued because of 1, over-optimism with regard to economies of scales. 2, the victim share price anticipating synergistic gains. And then 3, the victim shares price may be bind up in an auction. So one of the reasons why the net asset of the company may be 200, but we need to buy it for 300, it's because of what we think the business has. For instance, the synergistic benefits that we're going to get from the company, to the economies of scale that we're going to enjoy because we're going to have more market share and our average cost of production is going to reduce, and definitely the goodwill of the company in a nutshell. So that is why we always buy a business over the value that it is worth. But there are times when businesses are bought below their value, and I've mentioned, made references to that. Now, target issues to be discussed when we are undertaking a takeover. 1, what is the target worth to the predator? Can we extract maximum value? 2, what is the target worth to us? 3, do we want to sell the company? So this is from the target company's perspective, the management, the shareholders, they are going to ask themselves these questions. So as the predator or the acquiring company asking, how much can we pay for them? What is their worth? Are they ready to sell? They also would ask themselves a couple of questions. The first one is, what is the target worth to the predator? In other words, how much value have they placed on us? How much are they willing to buy our company? 2, what is the target worth to us? In other words, what is our business worth to us? Okay, so if they say they're going to pay us 300 million, how much is it worth to us as the shareholders of the business? 3, do we really want to sell this business? So if you look at how much they want to buy the business and how much you think your business is, then you would decide whether you truly want to sell. Because if you value or you think the value of your business is $100 million and somebody wants to offer you $250 million, then all other things being equal, if you don't think about the future benefits and talk about compounding interest and talk about the economics of scale and the benefit that you're going to enjoy when you expand and grow, then you will say that, okay, it's a good business. Let me sell it and let me take my hands off. So that is the third question that the shareholders in the target company ask. Do we really want to sell this business? 4, what is the after personal tax value of the offer? This is very important because you remember when the business is sold, we're going to get returns. We're going to get some value. That value we get, we have to pay tax on it. So what is the tax effect on the shareholders? Now, if the shareholders are in institutional investors or they are a mutual fund investors company or a venture capitalist company, then they wouldn't be willing to sell their shares. They will be willing to rather go for a share exchange so that there will be continuity in the existence of what? The investment or their interest in the company. Then the next thing is, if the offer is in shares, are they attractive? So for instance, if it is about share exchange, then is it an attractive share exchange that we are undertaking as a business? So we have to look at that, or the target company would have to answer these questions. The next thing to talk about is the market issue. The market issue. The target company shareholders are the ones who must approve the offer. Generally, most of the benefits on a takeover accrue to the target company shareholders. Now, there are things that the target company can do to defend themselves from being acquired. So defensive tactics. They can provide more information, that is, contest the offer on terms of being a poor offer, having no obvious advantage, and or employees opposition. So management can say that, okay, we don't want to sell this company because our shares are not valued well and our employees are not ready to sell the business. It's a defensive tactic to delay the acquisition. 2, issue forecast to indicate that the sales of shares is not a good option. So they can issue forecast and say that, hey, when we sell this business, it is not the best option. We have to continue to operate. 3, revalue the assets. So sometimes they will revalue the assets. So if the asset of a company is $100 million, they will revalue the assets and put it at somewhere $175 million. So when you come, the value of the business has risen about 50% or about 75%, and you'll be scared to undertake such sales or such an acquisition. Then the next thing is advertise, subject to the city code. So they can lobby to have an offer to refer to the competition commission. So they can lobby with the commission or the regulators about acquisition to come against the company that want to acquire us. Because, you know, competition commissions are there. In the UK, it's there to control competition and make sure that the market always is competitive and to prevent monopoly in the market. So if someone wants to acquire us, we can lobby with them and tell them that, hey, these guys want to acquire us. Tell them the acquisition is not possible. That is also one of the defensive strategies that we can adopt as managers and shareholders of the company to prevent an acquisition or a takeover. 3, Or the next one, poison pills tactics. Poison pills tactics. That is, the target builds in a tripwire to make itself less attractive. Example, create a new class of stock which automatically becomes redeemable at a high price in the event of a takeover. So this is also what we call the poison pills tactics. So if you want to acquire us, they will do what we call, they will create something that we call redeemable loan notes. Then they will say that, okay, we have redeemable loan notes, but if you acquire us, then the loan has to be redeemed. Maybe the loan nominal value is, let's say, $10 million. But if you acquire us, then the loan has to be redeemed. That is, prior before the maturity of the loan has to be redeemed at 3 times the nominal value. That means it's going to be what? $30 million. I bet you this is an element that would discourage the predator company from acquiring the target company. Right, so I included the examples of the general principles that the City Code talks about in the UK. Right, so let's look at the final aspects. Growth strategies. Now, there are 2 ways companies can grow. Companies can grow organically. Also, we have what we call organic growth, and then we have through acquisition. So organic growth, this growth strategy involves the establishment of new company by a corporate body using its own internal resources. That is organic growth. That is, okay, if we want to enter into insurance, we don't go and acquire an insurance company. We start an insurance company from scratch. That is organic growth. Then through acquisition is what we've already spoken about, where we buy the shares in another company called the target company. But it's always advantageous to start a business from scratch rather than buying a business outright. But it depends, because some people also prefer to buy an existing business rather than starting it from scratch. What is your take? Let's look at the advantages of organic growth. Less risky, because it is less risky because the company is not diversifying into non-core activities. Cost is spread over time, so you're not going to be paying huge sum of money to gain control. Opportunities for current employees. So the current employees of our organization will now have an opportunity to upgrade themselves on the corporate ladder. Rather than we acquiring a company, they also have their employees, and in the acquisition clause, they may include that we have to employ maybe 70% of their employees. Third, the source of finance for organic growth is retained and enhanced, less cost of capital. Usually, organic growth is from our surpluses or from our retained earnings. So the cost of that kind of growth, organic growth, is less rather than acquisition, outright acquisition, where you may have to do share exchange, you may have to go for a loan, or you may have to look for huge sum of money to invest or to buy a company. So these are the theoretical nuggets that you must understand when we're talking about acquisition and mergers. The next thing we will be looking at in the next module is to discuss the valuation of acquisition, or how we can value a business for an initial IPO.